So, hello everyone. As we discussed in our last meeting, we will do the next chapter, which is fundamental analysis, uh, and then we will do some part of technical analysis and mathematical analysis. Uh, all these analyses are required to gauge a perfect to find the right price for any stock to buy. Okay, so shall we begin? So as I said, we are going to do fundamental or fundamental and technical and Markowitz portfolio or mathematical analysis. So why do we do that? We need to do it because there is a running stock price, which is the current market price, and we are not able to decide whether this stock price is right or wrong, whether should we pay this price or should we wait for the stock to correct. So in this scenario we need to calculate or we need to find the right price, and we will we will know what is the value we can get out of it. So if the current market price is very high and you're calculated or you found out that the price should be here at this price, I'm going to buy. So this much value you are trying to this much value we are going to get. So we have to wait till the prices come to our required to our calculated or our found out price, and then after we know that the prices will rise up to a certain level or the price may go even higher. So that is the value we get, and plus the dividends they pay, that is also part of the value. So in this presentation we will discuss only about the fundamental analysis. The technical and the Markowitz portfolio theory I will explain completely in the next video, not in this one. So fundamental analysis, generally we are often told that it is very difficult to do and it is not an easy task and only big companies can do it, and we have to follow the big companies. But in last 10-12 years practice I have found out one way to find out the to do the fundamental analysis to find the right price of the stock. It's not the only way, it is one of the ways. I studied through the books of Security Analysis and Intelligent Investor. Also I have done the MBA part. So I have designed a way for calculation of stock price on my own. You can have your own way of finding the right price of the stock. Like some people they prefer to study the marketing ideas and the marketing patterns of any particular FMCG stock. For example, the people who already work in information technology or computer services business, they know how the IT companies behave. So that is the knowledge, that is the innate knowledge they get from the business itself because they have been there. uh, that is one of the ways anyone can do a fundamental analysis. But then another question is, what is a fundamental analysis? So let's have a look at the definition on Investopedia. Yeah. So the definition of fundamental analysis is a method of measuring the security's intrinsic value by examining related economic and financial factors. Fundamental analysis study Analysts study anything that can affect the security's value, from macroeconomic factors such as state of economy, industry conditions, to microeconomic factors like effectiveness of company's management, etc. Now this definition is very descriptive. So still as per the definition you need to then understand the strategy of the company, the marketing analysis, how their sales are done, how their channel partners behave, etc. etc. And it's not an easy task for an individual investor to perform. So we are as a retail investor or individual investor, we often have this issue of unavailability of the data required for our analysis. Another thing is, this is too much data to analyze for an individual. So it depends on personal interest. Some very high net worth investors, they have access to such data and they have an ability to access plus analyze such data and make a projection from it. In our case, in a retail investor, we can neither access, and even if we get the data, it's not easy to analyze. So often, if you will see the financial reports, annual financial reports, you will find that the company has disclosed their marketing or some kind of a proposed plan to how to increase their sales and how to reduce their cost and etc. and etc. And on that proposed plan basis, you can invest, but still we are unsure that this is a proposed plan and what actually will happen, what actually will be delivered, we do not know. So we have to wait for to find out what has actually been delivered. So you can make out from, let's say, if you take the financial report of 2019 or 2020, you can get a fair idea that wherein the company disclosed that what they are going to perform, what they are going to do in the coming year. And you can check for the financial at the end of the financial year 2020 or March 2021 financial report and see whatever the plan they have proposed and what actually they have delivered. What is the difference in their profit loss statement, in their balance sheet? If they have proposed that we are going to reduce the debt, whether the debt has actually been reduced from last few years, or they have said that we will we will reduce the cost, we will reduce the cost of manufacturing itself. So then you can see whether there is any changes in their cost of manufacturing, whether they have actually been able to reduce it, etc. So let's begin. We can download the annual financial reports from any company's website and you can check it into their investor presentation or investor relation heading. So what I generally do is I only consider I will straight away consider the financial statements, because I do not want to jeopardize my understanding on the basis of their marketing or sales plan and etc. and etc. So I only consider the financial statements. That is the best I can understand. Now there are three financial statements you will find in every company's annual reports: the balance sheet, profit loss, and the cash flow. Now the cash flow statement is a requirement of IFRS, the International Finance and Reporting System. So cash flow statement is generated by backward counting in profit and loss. Okay, so cash flow statement has three parts: operating, investing, and financing. So in which if you can take an example of any company, such as say any FMCG company, so you have to focus on the operating and the financing part of the cash flow. Why? Because the company is registered as an FMCG company, so the investing cash flows should be lesser than the operating and the financing cash flow. Please remember this. It is not easy, we often get distracted by the numbers, but we have to remember such nitty-gritties. Now if a company is listed as a mutual fund company, then in that case the investment becomes the operation. So then here again the operating and the financing part of the cash flow is more important. The investing here could be money lending or something. So again the criteria applies same, that the investing cash flow should be lesser as compared to operating and financing. That means the company uh, is doing a very good business, and then you can compare from company to company how their cash flows are different, or how their cash flows are what is happening in their cash flows and all. Okay, so I will not what I will do is I will simply skip through this, and I will straight away show you an Excel sheet just as a sample. So this is an Excel sheet which is I have devised it by myself. So I'm showing you just a simple example of a company called Marico, wherein I have analyzed their financial statements from 2020. So this is how I mapped. I'm considering all their assets and liabilities, and then this part here is considering their profit and loss statement in detail. So, and in this part here, it is the value of the business, the dollar retained, their year ending stock prices, return on equity. So from here onwards, it is all calculated numbers all the way up to the end. Okay, and this first part, which is asset liability, or this is the balance sheet, of which only the total assets, shareholder equity, and the total liability is the calculated part. So I whatever you see here in yellow, or we can say simply like this. Okay, so this part I fill it as it is, which is mentioned in the financial report. So why do I do this analysis? I can do this, I can get this information easily from any website or anywhere. That is correct. I am doing this analysis because there is a difference. There is a very small difference in between the analysis done by the websites or analysis done by everyone. Fundamental analysis is not a restrictive approach. It does not say that you can only do this and you should not do this. Fundamental analysis is little bit up to everyone's imagination, to about everyone's ability to study the financial statements. So after doing all this, I have found that the value of the business, which is owner's earnings divided by 8% interest rate. So here I am comparing that instead of keeping the money into the bank account and gaining 8% interest, if I invest in this company, what is the value of the business I am getting? So the value of the business is about 41,000 crore, and you can see that it has been continuously increasing, and last year it was at 3,89,000. Okay, so through all this analysis, what I am trying to find out is this. I'm trying to find out what is the calculated share price. So as per my calculation, in the year 2020, the financial year ended in 2021, the stock price of Marico is 318. Okay, and currently the stock is trading at somewhere about 500. So now if I want to invest in this company, I have to either buy the stock at the price it is being trading in the market, or I have to wait till the price comes to 318. So that is the logic what I am trying to derive. This is what I am trying to do. So you can create your own designs, you can create your own Excel sheets, or you can do the whole analysis also in Python. uh, you can find all the formulas from the internet. It's not the question of which formulas you use and what type of analysis you do and etc. It is actually a question of how do you arrive to your decision. Why we are doing all this to come up to a decision whether should I buy this company or should I wait, and what is the value it is going to give me. Correct. So the key takeaways from my Excel sheet are the return on capital employed. If the company has employed a capital of say 10 rupees, whether they are creating the sales of which are far more than that. Because for capital to be employed, they need to borrow some money, so they're going to pay some interest. So then in that case, the company's sales should be higher than the interest payments they are going to do. So I'm just giving you an idea. So that is how we find the capital employed. What is the return on equity as a shareholder? If I buy this company, if I not buy as in, if I buy the stock, some shares of this company, what is the return on equity they have displayed? Is the return on equity increasing? Is the value of the business is increasing? So how can I calculate the price of the business itself? What is the debt to profit ratio? Say if a company has a debt of say about 1000 rupees, they are paying an interest of 10 rupees. Whether they are able to generate a profit more than 10 rupees, where they can pay their debt and still have some excess income above, etc. So that is the whole idea of this whole complete analysis. Uh, Now often the question is, this whole analysis we can find out easily on the internet, and why do we have to do it by ourselves? It's up to everyone's guess. Okay, I prefer to do it by myself because I want to see the history. I want to see how how the company has evolved in last 10-12 years. That is one. Number two, I have found some discrepancy in between the published numbers in their financial report and the published numbers on the websites. So often I had that doubt that what should I follow, whether this is right or that is wrong. Number three, the details provided on the internet may change. I'm not saying they will always change, but they may change. And then in that case, your whole study may go wrong. But if you record the numbers from the financial report itself, then then you do not have to look back and continuously reconfirm that whether your study has been right or wrong. Now there are two. Now let's get into another basic part of this of the fundamental analysis. The another basic part is there are two types of approaches to do the fundamental analysis. The big companies, they prefer the top down approach, wherein they study what is the economy of the country, what is the economy of the globe, then what is the economy of the country, where the country is fared as compared to the whole global situation, then the sector within that country, how it performs, how the sector is performing in globally, then how the company is doing as compared to its peers in the same country, etc., etc. And then there is another bottom up approach, wherein we pick a company, then we see how they are performing, then we compare it with the sectoral players, then we see whether how is the economy and all. So none of the approach is wrong and right. The approach completely depends on the individual or the company or the institution. So I I as an individual investor, I prefer to do the bottom up approach because I do not select the companies on the basis of the sector or on the basis of management and etc. As an individual investor, I find the companies which I hear about them very easily. Companies like Britannia, DMart, Infosys, TCS, about whom I often read about whom there is a lot of studies done, etc. So it is very easy for me. I know these names, so it is very easy for me to find their financial documents and do the study. Now there are two more ways to complete your fundamental analysis. One is Michael Porter five forces and Ansoff matrix. So Michael Porter five forces gives you an idea about how the industry is doing. Okay, so you can find the information on the internet. It is very simple. So you put the industry in the center, and then there are four forces, four external forces acting on it, and the fifth force is the industry itself. So for example, you take an example of say automobile industry. So automobile industry, so uh, what are the threat to the automobile industry? Changing from IC engine to electric vehicle, which is one threat. Number two, the threat from the suppliers, the the companies who design and manufacture the engines or the suspensions or the systems, etc. So how the suppliers are forcing the company? Are the suppliers asking for more money every year? Are the expenses to the suppliers are increasing? So that is one. Then threat from the competitors. So how the competitors are fared? So whether the competitors are is the competition highly intense? Like right now, Maruti Suzuki has the highest market share in passenger vehicle. Tata Motors has highest market share in commercial vehicle. So then in that case, how the leaders are playing in this market, how the competitors are behaving against each other. And number four is the threat from the purchaser. So how the purchasers are behaving. Okay, so whether the sales are continuously same, whether the sales are increasing or decreasing, how the whole industry is performing. So that is, and now the industry itself, what they are doing for themselves to survive in this whole. So that is the Michael Porter five forces. I am just giving you a very small idea to, otherwise the video will just go on forever. Then the next one is Ansoff matrix. So Ansoff matrix is done only for the company itself. So if you find any company, then the Ansoff matrix tells you that you can evaluate the company in theory about in four parts, whether in terms of the products versus the markets. So whether the company is in selling existing products in existing markets, then how is the competition, where how they are fared. Whether the company is selling new products in the existing markets, then how the new products are fared as compared to the old one. Whether the company is selling new products in new markets, whether they are generating new markets for their products. So that is one question. Then last one is the diversification or a radical idea, where the company is doing something which is completely which they have not been doing before. They are into completely different markets and they are into completely different product lines. So you can find this information on the internet. So if someone is having a trouble to create the whole financial analysis for themselves, then they can take this approach. About the top down or bottom up approach, you can refer to many magazines, you can refer to blogs and etc., where you can find all this information. Michael Porter five forces and Ansoff matrix, you can find the information on the internet. Now the ease of doing this study. The study is comparatively easy, because even very big investors, big individual investors, even they have said that they often do not get more than 3, 4 or 5 ideas a year. Okay, so in a whole year you can hardly find a handful of companies which are suitable for your investment. So you do not have to open financial statements of every company and study them. Okay, you can make a choice on your own. Like someone may like to invest, someone may want to know about the tobacco industry, someone may want to know about the alcohol, someone may want to know about the FMCG or the textile, etc. So it depends on everyone's choice. It depends on their knowledge about that particular sector or field. So that is one way of doing it. So you find the areas, the businesses you like, then you can find the companies, and then you can do the sectoral analysis. The sectoral analysis, I have said, as you can do the simplest way is the Michael Porter five forces and the Ansoff. So that is one easiest way to do, because it depends on the personal choice how you can dig more. You can continue to dig more, and it may give you a different result. It's about everyone's discovery. So what is the value? Why are we doing all this? What is the value we are going to get? So value in simple terms is, I've calculated some price, say 20 rupees, which is my calculation, and now I want to invest this into this stock. The stock is trading at say 18 rupees or 24 rupees. So I wait for the stock to come up to 20. I buy at 20, and now the after 3, 4, 5, 10 years, the stock has increased all the way to 100, 200, then how many dividends I received every year, because the dividends you received is the one way, it is the interest you have received on your deposit. Okay, so that is one part of the value. Now the increasing value is the increasing in the share price is the another value. So it depends how do you do it. So but let's say the company's fair price, company is trading at 20 rupees, and I bought the share because it is at my calculated price, but the price is dipping. The price has now gone up to 10 rupees in that case, or 18 rupees or 15 rupees, but I have received some dividend. So then should I continue, should I stay invested, or should I exit from such investment? It depends on individual choice. Some people may prefer to have a stop loss of 20%, that I bought it at 20, so 20% of the 20 rupees is 4 rupees, so 16 rupees. So if the price goes below 16 rupees, I will exit no matter whatever happens. Some people prefer to say that okay, even if the stock price has dipped to 16 rupees, but actually 4 rupees I have received as a dividend, or 1 rupee or 2 rupees I have received as a dividend, so my effective loss is only 2 rupees. So I will kind of stay in here till I receive some more dividends, and I will wait for what happens in the company. So that is the way. So it changes from investor to investor, it changes from person to person. And now how to calculate the value, which I have just explained, and how to recognize the value stock. How to recognize the value stock? Very simple, is you have to only find the dividend paying stocks. That is simple. So just make a Google search, or you can check it onto the NSE website, where you can see the index of top 50 dividend paying stocks, and that is good enough for you. You can start your study from there. You can check on the internet about the company you want to know about, the company you like, and see whether they have been paying any dividends for last 3 4 5 years. If they have been paying any dividends, then if you are interested in investing in them, then you can invest in them. The companies who do not pay the dividend are called the growth companies, because they are inputting the dividend back into the company's business. So growth companies is a different way. The fundamental analysis remains same. The fundamental analysis will not change whether it is a growth company or a dividend company. The basic of the fundamental analysis is only to find the right price to pay. What is the difference in the actual trading price, and what is the difference, and your calculated price, and what is the value you are expecting? That is all is fundamental analysis. Very simple, in single line. Okay, so this is the end of it, and this is the end of the trading session. And if you want, I can do this analysis on my own about the companies you want, and for that I may charge a fee, or I may not charge a fee. It depends. So have a good time, and do the study on your own, and I will see you in the next video. Thank you.